There is a moment right now, happening across the UK, where millions of people are waking up to a terrifying truth. The dream of owning a home is dying, and it's being replaced by a corporate subscription model. Over 2025, the UK property market hasn't just slowed down, it's undergone a permanent, structural change. Mortgage rules relaxed to increase lending, a record number of private landlords selling up, massive corporate landlords investing more and more in the build-to-rent sector, and a new tax that could hit nearly every homeowner worth over £500,000. If you own property, rent property, or are dreaming of getting onto the ladder, what's happened this year is something you genuinely can't ignore. In over 14,000 transactions, worth more than £5 billion of property, I can tell you firsthand, I have never seen so many moving parts in the housing market shift at the same time, hitting ordinary people with such emotional weight. This isn't about supply and demand anymore. This is about power, debt, and the systematic dismantling of generational wealth. I'm going to break down the 8 biggest forces that are reshaping UK property forever, and why the next move you make, whether renting or buying, could define your financial future. Before we dive into the forces that are shaking the foundation of our economy, I need you to do one thing. This channel is dedicated to giving you the raw, clear, data-driven truth that the mainstream media won't touch. We are fighting to keep people informed, educated, and protected from these massive shifts. If you want updates like this every single week, if you believe in owning your future, hit that subscribe button and turn on notifications right now. It keeps this critical conversation alive. Now, let's get into the dark heart of the market shift. Most of the mainstream press missed this, but it directly affects who can and can't buy a house in 2025, and it's terrifying. The FCA, the Financial Conduct Authority, quietly updated lenders in March on how they should apply the mortgage stress test rule. Let me explain this simply because it cuts to the core of your financial safety. Since 2008, banks had to stress test every mortgage. They didn't just check if you could afford today's 5% rate, they tested if you could still afford it if rates jumped to 7% or 8%. That rule was meant to protect you from disaster, to protect the whole system from collapse. But here's the problem that the banks complained about: rates are now falling in 2025, yet many lenders were still using harsh assumptions, like testing against sky-high reversion rates plus an extra margin on top. In practice, this meant a lot of first-time buyers and switchers were being rejected, even though they could easily afford the payments at current interest rates. So, what did the FCA do? They told lenders, you have more flexibility than you think. Don't use automatic sky-high rates. Base your tests on realistic market expectations for the next 5 years. If rates are trending down, reflect that. And they reminded banks of the new consumer duty rule: you have to offer fair value. Don't design your mortgages in a way that unfairly locks people out. This isn't as dramatic as scrapping the stress test, but it is a quiet, regulatory loosening. It's a signal from the top that they want more mortgages approved, more transactions, and more demand. But here is the hidden trauma: the government is essentially enabling you to take on debt closer to your absolute maximum capacity. They're telling you, go ahead, stretch. It makes you feel like you've finally been approved, like you've won. But what happens if the realistic expectations they based your approval on are suddenly wrong? You are the one left holding the risk. This isn't about helping you afford a home, it's about making sure enough people are still borrowing to keep house prices propped up. The system needs growth, and you are the grease on the wheels, even if it means putting your future on the line. But that wasn't the only way they greased the wheels. Rightmove and Zoopla are both reporting the highest number of homes on the market in over a decade. Listings are up 10% year on year. That sounds great, like the market is finally opening up. But look closer, demand is up only 4%. Sellers are chasing buyers, not the other way around. This sudden supply surge isn't a sign of confidence, it's a sign of distress. Who are these sellers? They are the ones who bought at the height of the market, lured in by those cheap 2% or 3% fixed-rate deals from 2020 or 2021. Their deals have expired, and they are now facing a remortgage bill where their monthly payments are jumping by 30%, 40%, or even more. We see it every day in our agency. People are literally staring down a £500, £800, or even £1,000 extra payment every single month. This is the emotional cliff edge. Some can't afford to refinance and are being forced to sell. They are selling not because they want a bigger garden or a new area, but because they have to avoid foreclosure, to avoid losing everything. The market is being flooded by the assets of people who are financially broken by the rate hikes. And who benefits? Cash buyers, institutions, and the very people who created the debt cycle in the first place. The government is relaxing lending rules for Force 1 precisely because they know this huge wave of forced sellers, Force 2, is hitting the market, and they need a new supply of stressed buyers to soak up the homes before prices truly crash. It's a desperate attempt to stabilize prices by risking the financial health of the next generation of homeowners. And what happened next to the rental market would shock everyone. The renters' rights bill, all the uncertainty, the reduced tax relief, it's driving individual landlords out of the market. Now, I know what many of you are thinking, good riddance. Less competition for buyers. But it's a terrifying double-edged sword. Short term, this drop in supply fuels a huge spike in rental prices, which we are seeing. Long term, something far more sinister is happening. Corporate landlords are stepping in to capitalize. The government commissioned its own report, the English Private Landlord Survey. This report, funded by the state, found that large landlords, those with 5 or more properties, are twice as likely to have evicted a tenant in the past year. They are significantly more likely to raise the rent between tenancies or during renewals. The numbers are stark. 75% of large landlords increased rent for new tenancies. The report also found that small landlords, the ones with just 1 or 2 properties, are far more likely to hold rent steady, especially for long-term tenants. Why? Because they are often more lenient, more understanding, and sometimes, yes, more emotionally invested in their tenants and their community. They are human. The small landlords, the statistically better landlords, the ones with 1 or 2 properties, are the ones most likely to be planning to sell because of the increased regulation and uncertainty. And who's staying behind? The big boys, the corporates, the ones who treat a tenant not as a person trying to make a life, but as a number on a spreadsheet, a line item in a quarterly report. This bill, with the best intentions, is widening wealth inequality. It's pushing out the local coffee shop owner who rented out their flat, and it's replacing them with a financial institution. We are losing the personal service, the flexibility, and the local trust that's vital in any community. That feeling of being disposable, of knowing your home is owned by someone you could never call, will only intensify. This leads directly to the true predator in the market. Today, we are no longer just competing with day-to-day buy-to-let landlords. We are competing with BlackRock, Lloyd's Bank, Legal & General, and Blackstone. They don't own a few dozen homes, they own thousands upon thousands of them. They are buying entire developments before they ever hit the open market. Entire streets are being turned into corporate rental blocks. BlackRock is taking this control even further. They are buying into brick manufacturers, literally controlling the building blocks and the supply chain of the UK housing market. This is how much they are backing it. Blackstone is buying up railway arches. Why? Because housing is a perfect investment asset. Inflation makes rents go up. Debt stays fixed. And fundamentally, people always need a place to live. The chilling, raw truth is this: housing has become too profitable to leave to the people, to us. People who rent have to pay rent, even when everything else collapses around them. Think back to Maslow's hierarchy of needs. Food, water, and shelter are our core needs. The massive corporate landlord knows this. They are monetizing your fundamental survival instinct. They see a home not as a place to raise a family, but as a safe, recession-proof, yield-generating asset. When you see an entire new development, you need to ask yourself, is this neighborhood being built for homeowners or for shareholders? This is a question of dignity. But this corporate control has a specific geography to its greed. The corporate players aren't just buying homes randomly, they are targeting specific, high-growth areas, and they are doing it with algorithmic precision. This is the geography of greed. Their focus is overwhelmingly on large, purpose-built, high-density housing blocks in cities or the commuter belt. They want uniformity, which makes management easy and predictable. They prioritize brand new builds because they require less maintenance, and corporate investors get early access deals with developers. This means the housing supply that should be going to first-time buyers is being vacuumed up by institutional funds before the public even knows the properties exist. What does this do to a community? When an entire street, or a whole apartment complex, is owned by a fund in New York or London, what happens to neighborhood involvement? What happens to the long-term investment in schools and local services? You get a soulless suburb, places where people cycle in and out on 12-month leases, with no stake, no long-term commitment. It turns vibrant communities into transient accommodation, stripping away the social fabric that generations have worked to build. The feeling of rooting yourself in a community becomes a luxury, not a given. This process turns housing into a completely disconnected financial product. And we see the financial risk being pushed onto the borrower in other ways, too. Remember Force 1, the relaxed stress tests? Well, there's another hidden change compounding that risk, the loan-to-income, LTI, flow limit change. From July 2025, only lenders issuing over £150 million annually are bound by the rule limiting high LTI loans, that's 4 times your income, to 15% of their new mortgages. Smaller lenders are now exempt. What does this mean in raw, relatable terms? It broadens access to high-income multiples for borrowers. We are starting to see lenders offer 5, even 6 times your average income. This is presented as a gift to the first-time buyer. Finally, you can afford that house. But it's a false promise of access. While the system says you can borrow 6 times your income, the truth is that it pushes you into a state of financial fragility. Imagine you're a young professional. You can now borrow £300,000 on a £50,000 salary. You get the house, you've won. But one unexpected life event, a job loss, a medical emergency, a relationship ending, and that 6 times income debt becomes a crushing, inescapable burden. You are instantly house poor. The government is selling you a feeling of security, ownership, by forcing you into a reality of intense financial insecurity, extreme debt. They are using the small lenders as a loophole to put high-risk debt back into the system, and the risk, as always, is 100% transferred to you, the borrower. All of this borrowing and all of this property value is currently sitting atop a tax time bomb. The biggest wild card of 2025 is taxes. HMRC already raised nearly £15 billion from stamp duty last year, despite the slowdown. But influential think tanks and political parties are aggressively pushing for a new tax regime. The core proposal is the introduction of a land value tax, LVT, to replace council tax and, critically, stamp duty. Leaked proposals suggest a new levy on homes over £500,000 could be something that comes into play. If that happens, the impact on middle-class homeowners, particularly in the Southeast, could be absolutely seismic. This is the part that feels raw and relatable because it hits the average person. When you hear £500,000, you might think of a mansion. But let's look at reality. In the London commuter belt, £500,000 buys you a modest 2-bed flat or a small 3-bed semi that needs work. You spent 25 years working, saving, sacrificing to pay off that mortgage, and now the state is proposing to levy a completely new, ongoing wealth tax on the only major asset you own. It's not just a tax on the wealthy, it's a tax on the strivers, the savers, and those who finally achieved the middle-class dream. This tax would effectively lock people into their homes. If you have to pay a massive annual levy, you are less likely to move, which freezes the market. The proposed tax is designed to generate vast revenue, but in practice, it's a punitive measure that punishes generational stability and saving. It's the ultimate betrayal. You bought into the system, and now the system is coming for your stake. Let's step back and look at the whole picture. When you connect all these threads, one overarching, chilling theme emerges: the great wealth transfer. Mortgages are easier to get, but this risks inflating prices again, pushing more debt onto fragile borrowers. Supply is up, but it's mostly from people being financially forced to sell off their generational assets. Landlords are leaving, but corporates are circling, replacing human landlords with faceless, profit-driven entities. Taxes could penalize the very people who manage to achieve homeownership, forcing many to sell or face financial ruin. The UK property market has changed forever in 2025. It is no longer a system designed to facilitate stable homeownership. It is a complex mechanism for transferring generational wealth, your parents' and your hard-earned equity, from private families and individuals directly into the coffers of global financial institutions. This affects you because it defines the kind of society we will live in. A society where shelter is a secured investment for the few, and a crushing, ever-rising subscription cost for the many. We have never seen this kind of simultaneous pressure on the housing market. The systems designed to protect us, like the stress test, have been subtly loosened. The regulation meant to protect renters is pushing out the most empathetic landlords. And the threat of a punishing new wealth tax looms over the heads of the middle class. The question isn't if the market has changed, but how you will respond. Do you think these changes, the loosened debt rules, the corporate control, and the tax threat, will stabilize the market for the average person, or push it into something entirely unrecognizable? If you found this clear, data-driven update valuable, and you believe in understanding the forces shaping your life, make sure you've subscribed, hit the bell notification, and importantly, share this video with someone who needs to understand this, because the more of us that understand the problems in the housing market, the more likely it is we can push back for change. What happens next affects all of us.